Welcome back to Turning Hard Times to Good Times. I'm your host, Jay Taylor, and Alasdair Macleod is with us again. Very thankful for him agreeing to join us at this late hour from his home in the UK. Thanks for being with us again, Alasdair.
That's my pleasure, Jay.
Well, it's really great to have you with us, and would like to talk to you today about your May 21st article, A Path to Monetary Collapse. And I should tell our listeners, again, as I like to do every time we have you on, that they should go to goldmoney.com and the research page at goldmoney.com and pick up your weekly missives, because I think they're very insightful and help us to understand why things are happening the way they are. And in that way, be a little better prepared to protect ourselves against all kinds of things that are coming our way these days. I want you to talk a little bit about that article, The Path to Monetary Collapse, but I would really like to also get your ideas just in general about the UK economy right now, and the European situation in general, if you would comment on that. How dire is it looking now? I'm looking. For example, I was looking at a website here, I think it was the Atlanta Fed. They've got a GDP, a Q2 GDP in the U.S. of negative 52%. I mean, I can't get my head around that.
Well, it is an annualized rate.
Yeah.
Just to cheer you up a bit.
Yeah, okay.
But I think that's revised, isn't it, Jay? From around about, I think they were saying about 41.8%. So they've revised it downwards.
Yeah, I just saw it's 52.8, so it's not. Yeah. Okay, so you're cheering me up a bit, but even so, it's pretty dire. So just quickly, what are your thoughts about the UK and, of course, the Brexit splitting away from the UK? Just comment a little bit on. I mean, is the entire Europe in a depression?
Well, the answer is yes, and I don't disbelieve what the Atlanta Fed says about the second quarter in America either. We've been talking about this, I think, for about the last year or so, that we are headed for a depression. Let's call it a depression. It's something on the same sort of scale as we saw in the run-up to the 30s. We haven't seen a real collapse in the stock market yet, but we've seen the first leg down, which was really rather vicious. We're in a recovery phase, and the Fed is doing what it did back in the late 1929. It's trying to sort of puff the markets up to keep it on the road. But when Hoover signed not the Glass-Steagall Act, when he signed the Smoot-Hawley Act into law, I think it was about May or June 1930, the market just went down and down and down and down. And at some stage, I think that the inflation bubble, which is now in financial assets, that will pop. And then it's a whole new ball game. As to what will pop it, what I certainly see is nobody seems to be talking about systemic risk, and that I think is something we should be concerned about. Things happen which tend to be unexpected in these times. The point about systemic risk is that the banks are horribly, horribly exposed to this economy. They have literally no ability to absorb what they call non-performing loans. To you and I, clients have gone bust. And they are at the moment trying to reduce their exposure because they've moved from greed. Bankers have moved from greed to abject fear very, very quickly. And who would blame them? I mean, if you've got quite a lot of balance sheet gearing, it's lovely when things are going well, but my goodness, it's horrid when they're not. And that's why, the switch from greed to fear, very, very sudden. And what banker would not be very fearful in these conditions? I think that's the simple question. I can't think of any banker, even an idiot banker, who would not have noticed that things aren't going quite as he perhaps expected 5-6 months ago.
Yeah, I would suggest there's quite a few of those kind of bankers around, unfortunately. But I think the system really encourages idiot bankers because there's always a bailout, they think. And there has been so far. for the most part, the big boys.
Yes, I think to be fair to the bankers, they don't actually proceed in their business with the expectation of being bailed out. Though, I mean, you could argue that subconsciously they must be reassured that, if everything goes to hell in a handcart, then, at least we're big enough for the Fed to bail us out. I mean, I'm sure there is a bit of that attitude, but banks, basically, bankers are just like us. I mean, they're greedy for profits. And when it's easy money and you can print the money in the form of bank credit, what's not to like about it? Except when the economy turns south. And when the economy turns south, you've got a lot of bad debts coming your way. So the question is, what do you do? I mean, do you try and reduce your exposure to the non-financial economy? Well, if you do that, what happens is you just undermine more of your customers, because if you stop lending, say, to a medium-sized business, all the small businesses will go with it. Large businesses, it's even worse. So, no, what you do is probably you tell people with various trading desks within the bank, we're going to cut your limits. And I think this is something which is actually happening on COMEX because, banks are trying to withdraw from COMEX. I mean, they have made losses, yes, but the real underlying problem is they've got to find somewhere to limit their liabilities because of what is going on in the wider economy. So they're cutting back on derivatives of various sorts. Things like FX swap market, they won't want to do that so much. They see the losses that are piling up when they get out, and suddenly they think, well, we just want to cut that line of business, which is what Scotia did. But admittedly, Scotia were going that way anyway. So it's not really a very happy scene for bankers. We might say that they deserve it, but actually, unfortunately, we do rather need them.
We need them, but we could use bankers that are not so greedy, I would dare say. And
yes,
I mean, but Alasdair, the whole fiat money system allows and enhances this greed, right? Exactly.
That's the whole thing. And if you don't make use of it as a banker, then you're going to get sacked.
Well, exactly right. I can remember a CEO of when I was at Westpac Banking Corporation, Tony Walton, telling us lending officers that we better make some bad loans along the way, or we're not doing our job. In other words, push the risk curve out there. And I thought, what? That doesn't sound right to me. Coming out of credit, I was always trying to make sure that we didn't, or that we protected the depositor's money. I thought that seemed out of place. But anyway, Alasdair, you had indicated previously when we talked that you felt that the U.S. banks were in relatively good shape. Their capital structures were pretty strong, relative at least to the Europeans. Do you still feel that way? And then I would say that if you're having a 52% negative GDP in the U.S. in the second quarter, what bank would be strong enough to withstand?
Well, I think you make a very good point, Jay. But if you think that the American banks are in a weak position, you haven't really looked at the European banks. I mean, I look at Société Générale, the big French bank, and these are globally, systemically important banks, which are meant to have extra buffers and all the rest of it. But if you look at their market cap and compare that with their assets, the assets on the balance sheet, you get a leverage in SocGen of 121 times.
Holy mackerel.
Regulators will say, oh, no, you don't need to look at that. You need to look at the balance sheet, the shareholders' funds on the balance sheet, and make the comparison. And then that looks lovely. But the problem is that the market is telling you something different. The reason that SocGen shares are way down the pan is because the market understands that this is a very risky operation. And that's why your leverage is up at 121 times. Other banks like Deutsche Bank looking at about 80 times. Group Crédit Agricole, 78 times. Barclays Bank, our own bank here, 63 times. If you look at JPM Chase, they're about 9 times. Bank of America is about 11.4. State Street is 11.3. So you're in a completely different league. Now, I'm not saying that your banks won't go under in a real smash, but what will happen, I think, is that the banking crisis will start in Europe first. And on that basis, you get the ripple effect. You've got counterparty exposure, the whole thing. The money markets will seize up. And then you've got a real crisis on your hands. And the only way out of it is really for the central banks to just print the money, for the governments to nationalize them. And so that's yet another bill, which is going to be paid for by printing money. So it's this, I think, is the next shoe to drop in this crisis.
Yeah, and endless amounts of money being printed, and of course, central banks already buying up. I think it's the Swiss National Bank that's buying all the tech companies, right? So I mean, you'll have all of these. What will be left of the private sector, Alasdair, as things are going the way they're going?
I think there's a slightly different emphasis there. You have central banks are basically trying to puff up financial assets. They need to do this because governments who are borrowing a lot cannot afford to pay higher interest rates. So they puff up the assets. They want to stop corporations falling over. So what they do, they buy corporate debt. Other central banks, sovereign wealth funds, are buying equities. So it's just, as you're right, the right word is it's just the nationalization of markets. But it will fail because the scale of it has got to be too big for it to succeed. And not only that, but it'll take the currencies with it, which is why I'm on record as saying that I expect fiat currencies to be over by the end of this year.
Fiat currencies to be over by the end of this year, which leads us to your article then, the path to monetary collapse. And help us understand how that can unwind, because I think it's just really difficult for people to perceive. Those of us that have lived in the dollar, in the dollar-centric universe. So things start to topple over. Insolvency spreads. It leads like dominoes falling over one to another. There's very little equity. The debt to I mean, you started out with your article, you talked about how central bankers think about the current situation. It's different. And you've made this distinction before on the show that basically central bankers, they think it's a business cycle when in fact it's a credit cycle of their own doing, right?
That's correct, yes.
And why is that important? And why is that important, that distinction, in the minds of central bankers?
It's important because the only solution that they have is to pursue the policies which got them into that position in the first place. So, we're now openly talking about negative interest rates in the dollar. I mean, that would immediately put gold and silver and every commodity into backwardation if that happened. I mean, this is just really crazy. But central bankers just don't see it. It's Keynesianism gone mad, if you like. It's the ultimate end of Keynesianism. And the best way I can explain this is to compare it with John Law back in 1720, when he tried to get his Mississippi venture merged with the Banque Royale, which was a sort of quasi-central bank which he'd set up with the authorities' approval. He was printing the money to buy the shares in both ventures. Now, it was a support operation, but he couldn't actually keep the thing going, even though he had total control over the currency. And what happened by the following September, we're looking at September 1720, was that there was some notional value left in the shares of the Mississippi venture, but the livre, the French livre, John Law's livre, was worthless. And it literally, by pursuing this line of tying the currency's future to the future of financial assets, when it collapses, they both go. And that's what we face. I mean, we haven't started yet, really. I mean, we have this situation where, we know it's all shut down and we know businesses are shut down and so on and so forth. We're hoping that as they open up, we will return to some sort of normal, whatever that is. And yet you've got the Atlanta Fed saying, the GDP in the second quarter looks like being down 52.8%. I mean, How do you recover from that? And how do you recover from that when you remember that even before we had the virus, we were having liquidity problems in the repo market, which was telling us that the banks were no longer lending at the pace to keep the whole show on the road. They needed extra liquidity. They were in trouble before this virus started. And on top of that, your wonderful president is fighting a trade war against China. And whatever the merits of that, it is economically destructive. So, before we went on air, you were sort of coming out with a catalogue of things that we face. I mean, it just doesn't look good, Jay.
No, it really doesn't. It sort of reminds me of what you're talking about, John Law's situation there, where the Libra became worthless. It sort of reminds me, I think it was Jim Rickards, I saw a tweet the other day in which he said in Germany, the stock market was rising for the longest time, and people said, who needs gold? Until one day they woke up and realized that their stocks that were denominated in the German currency were worthless. Worthless against the mark. I mean, the mark was worthless.
Yeah.
So what if you had a big number of marks attached to a share of one of the German companies? It meant nothing.
Yeah, exactly. There's no escape saying, well, I'll hold equities as an inflation hedge. No, forget it. It doesn't work under these conditions.
But isn't that what they're doing? Isn't that what people are doing now in America? They're looking at the equity markets. Again, it's pretty strong today. Somehow it just seems to defy gravity. Equity prices just seem to be strong. And they, in the light of this kind of disastrous stuff that's going on, I mean, every major city across the country is being sacked now by these vandals. And, we have the COVID, we have a depression, we have a trade war, we have all these things going on. And so, all right, so that's what happens then. The currency becomes, this is why you keep talking about the John Law experience.
Precisely.
Because that you think that's the closest analogy to what's going on now in America or in the whole Western world, I suppose, right?
In the whole Western world, John Law basically came out with Keynesian policies in the early 1700s, and he managed to persuade the French to buy into it, and he destroyed France. This time, everyone is doing it, and they're doing exactly the same policies in terms of currency and market management as John Law did to a T.
It's incredible. All right, so that's the path. How soon? So you're thinking by the end of this year.
I think it's quite possible.
You've gone on record as saying you think by the end of this year, fiat money may be kaput. And if that's the case, then where do we go? What do you see happening?
Well, what I'm doing is I'm going into sound money, which is gold and silver. I mean, I think there is nowhere else to go.
That's the obvious.
I mean, if you're a fan of Bitcoin, there's a story there as well. But you just need to think. Don't go with it to the death, because what's Bitcoin going to be measured against? It'll be measured in gold in the absence of fiat currencies. And if you measure Bitcoin in gold, you don't need Bitcoin. So,
Alasdair, what do you think? So far, interest rates are heading with I see we have about 3 minutes left. Interest rates are heading down because they keep obscuring the true cost of capital by pumping more money in the system.
Yeah.
So we don't know what capital costs really are. Of course, they're changing, I suppose, right now. Who knows with all the destruction. Interest rates, though, do you think that the U.S. will go into negative territory this year?
Well, I don't know. It would be the most stupid thing to happen. And I think also that the commercial bankers will be telling the Fed, don't do it. This is nonsense. We don't want a tax on our deposits. Mm-hmm. But on the other hand, President Trump in an election year, I think, would be desperate for the Fed to do anything like that. So it'll be interesting. I think poor Jay Powell will have the president blasting him off in one ear, whereas all his friendly bankers will be telling him something completely different in the other. Mm-hmm. I don't know how it'll work out. I mean, it could be that things start sliding before that happens. I mean, if you get a banking crisis, is negative interest rates appropriate to deal with it? No, I can't see it is. I think it would make it worse.
Yeah. Well, yeah, you would think so. And you've made the very good point. Again, I think this whole idea of the need for time value of assets, and that gold, for example, has a time value or an interest rate, if you will.
Yeah.
And so if you push the interest rate in the U.S. dollar treasuries to negative, why wouldn't everybody exit the dollar and go for gold or go for some assets that have some positive carry?
Well, absolutely. It doesn't actually need to have a positive carry. It's the time preference, which you mentioned, which actually matters. And that is the moment you have negative interest rates. In fact, the moment you have zero interest rates in the dollar, you have got, it may not be reflected in balance sheet terms or in paper currency terms, but you have got a backwardation in everything. So it just really does screw up everything.
Yeah. Well,
I think, something like the euro could probably get away with it, as we have seen, because international commodities are not priced in euros. But the dollar is different.
Yeah, well, you made that point before, and it makes total sense for me. I know there are people that will claim that no matter what, the people have to own dollars. But I tell you, if it goes the route of the Libra, I'm not sure. If there aren't a lot of people who won't change their mind on that view. Yeah. Anyway, anything else you'd like to pass along to us? With a minute left, my engineer says 30 seconds.
Yeah, I think, read my articles at Gold Money. I'm writing one on silver, which will be published on Thursday afternoon EST.
Good. And what was the one you just put out, the last one?
I'm trying to remember.
Well, we talked about the one on May 21. I know there was one since then. I usually have all of them in front of me, but my apology. The point is, people should go to goldmoney.com. Go to that particular page there and read Alasdair's work, and you won't be sorry that you spent a few minutes to do so. Thank you so much, Alasdair, for being with us once again.
That's very much my pleasure, Jay.